Connor Browne, one stock you like in the Thornburg Value Fund is Grand Canyon Education. It's been a rough year for the for-profit education stocks. This stock's down, I think, around 18% so far this year, but it's been better than its peers. So what turns it around?
Yeah, it's very out of favor space, as you point out. We think Grand Canyon has a differentiated model, though. They operate a ground campus in Phoenix, Arizona. It's a beautiful campus. Look it up on the website. And growing that ground campus where they're getting good outcomes for a student at a good price strengthens the online brand. We think they have a differentiated model that can drive predictable earnings growth.
All right, you're also a fan of Seattle Genetics. This stock's up around 30% this year, but it's been a really wild ride with a lot of the other biotech stocks. They're in the oncology space, a little bit of immunotherapy there. So tell me why you like it.
Yeah, so this is a setup that we've invested successfully in biotech and healthcare over the years at Thornburg. We found Gilead Sciences in 2002, initially invested. Seattle Genetics feels like it could be our next big winner in the space. We think that in upside to the current valuation of the company is justifiable just on their one approved drug in the marketplace. It's called Adcetris. It treats bloodborne cancers. They've got 7 clinical programs, early stage clinical programs, another 4 headed into the clinic later this year. Lots of shots on goal. If one of them hits, it could create a whole nother doubling of the market cap of the business.
All right. Well, you also like Weatherford International. This is down, I think, around 15 or 16% this year. They're in the energy services business, but it's actually underperforming their peers like Halliburton and Schlumberger. So why do you want this one as opposed to some of the others?
Yeah, sure. We think it's really opportunistic right now to get into Weatherford. They're the number 4 now. They will be the number 3 oilfield service company after Halliburton and Baker Hughes merge. We think there's opportunity created by being the number 3 to get some market share from the majors. It's been a poorly managed company for a long time. We think management, though, today is doing the right things, cutting costs. They're generating free cash flow in this very tough oil price environment, and the benefit of those cost cuttings will come through if we see a recovery in oil prices.
And then finally, Facebook. They've had a great year. It's up around 30%. And big cap tech has done great so far this earnings season. So what takes Facebook higher? I think they report next week, so we'll hear from them then.
They do. Wednesday of next week, Facebook, we're frankly fascinated by the move in eyeballs from linear television to other ways of consuming media. Still 40% of brand advertising budgets, of global advertising budgets are spent on TV, linear TV, even as viewers are moving away. It has to go somewhere. The combination of that with the incredible data that Facebook has on users creates a really exciting opportunity. We think that Facebook, over the next few years, will be able to monetize their users much better than the market is expecting, and will drive upside in the shares.
All right, well, thanks a lot, Connor.
Thanks.
And thank you for watching The Street.